If you're looking to get started with investing, invest a large sum of money, or optimize your investments, you're in the right place. What's up guys, Frankie here, and I have been super excited to pull this video together because I have to say investing, for me anyway, was one of the scariest topics when I set my money resolution roughly 3 years ago. I'm excited to share what I learned, give you some really specific tips, as well as some background and context, and just all of my thoughts when it comes to investing and what to invest in as it pertains to financial independence and retiring early. I'm hoping you'll walk away with a really good understanding of the strategy that most people in the FIRE community employ and have a really good sense of which stocks, bonds, and or mutual funds you should consider investing in. Hint, it's not stocks. And stick around until the end because I'm going to cover what a lot of people are automatically invested in within their 401k, which is target date retirement funds. Thumbs up or thumbs down. I'm gonna start with the good news about investing. It is actually pretty simple. When you can understand and know the difference between stocks, bonds, and index funds in which you should invest in, and also how to avoid fees. Once you have a basic understanding of these concepts, which I'm gonna cover here in the video, investing can be super hands-off, super stress-free, and if I'm being honest, kind of fun. The best part is you're still going to outperform almost everybody, the vast majority of people that try to pick individual stocks to get ahead. No tricks here, no gimmicks, just really basic math and some historical studies, of course. With that, guys, be sure to like this video if you get some value out of it and appreciate all the work that went into this. Let me know your thoughts about investing down below and your thoughts on this strategy in particular. Was this helpful? Did you learn something? Do you disagree? All that's fair game. And of course, subscribe to The Money Resolution if you haven't already. I put out videos roughly once a week. I'm on a mission to retire early and I want to share all the best tips and strategies to help you do the same. Oh, and ring that bell so you'll get notified about future videos. Truthfully, I was inspired to pull this video together after listening to a podcast episode from the Bigger Money Pockets podcast in which they interviewed J.L. Collins. Shortly after that, I even went to the library and picked up his book, The Simple Path to Wealth, to begin rereading this because yes, it's that good. And in that interview, he explained the 7 basic rules that all investors must know. And I'm gonna quickly cover that here because it is essential to have your head around the mental side of investing before we just go picking stocks and index funds. And I'm gonna paraphrase here, but number 1, he said, market crashes are to be accepted. Number 2 is the market always recovers from these crashes. Number 3, the market always trends up. Number 4, it is a best performing asset class of all time. You could go the real estate route and make more money that way, but it's also kind of a part-time job. Number 5, the next 10, 20, or 50 years will have the same amount of crashes and problems as the last 10, 20, 50 years. Number 6, instead of panicking when the media goes crazy, ignore the noise. The market does this. And number 7, of course, is to stay the course. Ride out the storms. You'll be better off on the other side. Finally, he added, in the end, if you understand and internalize these rules, you'll get to enjoy the benefits during the relentless, steady march up in the long run. And he even says for new investors, a market crash could be one of the best things that happens to you because not only can you buy stocks on sale, you're gonna learn by writing it out firsthand that that is the best approach and strategy. All that said, what should you invest in? Because that's probably what you came here for. This is a perfect time to give a really obvious disclaimer. I am not a certified financial planner or advisor. Neither is J.L. Collins. He's a blogger to my knowledge. You should not take your investing or financial advice from some finance nerd on the internet. Please do more research if you have a lump sum of money that you are looking to invest or you're considering making changes to your current portfolio. First rule you need to know about investing as it pertains to your retirement is do not pick individual stocks. Individual stocks can flop and you could lose big, like up to 100% pig. With a mutual fund or a group of stocks, the potential is huge, actually beyond 100%. Nobody can reliably pick stocks successfully and outpace the market, at least not for 10 years. Plus with stock picking, you're gonna have higher taxes, higher fees, a lot more research is probably gonna have to go into it. Plus it honestly does require a little bit of luck. Not to mention, because of our own psychology, we tend to buy when things are high and sell when our stocks are low. We think we can ignore emotions when things start to drop, but fact of the matter is most people can't. Yes, you might be able to beat the market for a year or two, but 10, Not a chance. In fact, odds are roughly 1 in 1,000. Instead, I'm here to recommend broad-based index funds because with these, as the market succeeds, and it will, it always has, you'll succeed. I am going to recommend a few funds here because these are ones I've heard over and over again. J.L. Collins specifically stands by 2. And if 2 sounds easy, he actually says you could be great with just 1. And the best part, of course, is once you set it and forget it, you no longer have to think about it. Never put individual eggs in one small basket. Buy all of the eggs, all of the baskets, the total US market. Then hold them for the long term. Now, which funds to buy? For your main fund, you're gonna pick either the total stock market, which he recommends, or the S&P 500. You can supplement these with total bond index funds. That's what I'm gonna cover here next. And after that, I'm gonna talk about target date retirement funds. So first off, again, invest in the total stock market. Like I just talked about with baskets and eggs, don't buy one, buy them all. That's all roughly 3,600 publicly traded companies in the US. This is a safe, proven approach. Index funds are the most efficient investment you can make. They're meant to replicate an index. So it could be a sector, for example, think things like tech or medical. But I'm talking about picking all, not one sector. Why would you do that? Well, just like we can't predict which stocks are gonna take off, we can't predict which sectors are either. Now, while we cannot predict, one thing we can do is look to the past. And on that note, during this podcast interview, Jim went on to quote Warren Buffett, and I wrote it down, and I'm sure I butchered it a little, but essentially he said, if you look at the last century of the stock market, in 1900 it was 60. At the end of 2000, it was 11,500. How do you possibly lose money in this scenario? By trying to dance in and out of the market. So buy a total stock market index fund, hold it for the long term, and the market will reward you for it. The more you tinker with it, the worse off you're gonna be. So just keep it simple. Smarty. And I thought this was funny. To illustrate that point, he cited a Fidelity customer account audit, which revealed that the most successful group of people when it came to investing were dead people. Number 2, people that forgot about their account completely. Okay, here is ultimately the fund that he recommends. It is VTSAX. That is the Vanguard Total Stock Market Index Fund. There is a similar ETF version of this. It's called VTI. You can't go wrong with either of these really. Again, with VTSAX, if you buy this mutual fund, you're buying all publicly traded US companies. Plus, the reason this fund is recommended specifically is this is gonna keep your expense ratio down, like almost as low as you'll see anywhere. At the time of writing the book, it was at 0.05. It has gone down since then to just 0.04%. For perspective, in the book, he cites that the average mutual fund is going to run you an expense ratio of 1.25%. You're going to pay far less in fees. That's going to be a lot less drag over time, and it can add up to a shocking amount. So VTSAX is J.L. Collins' very clear and obvious recommendation if you read this book. In fact, I'm pretty sure you're going to see VTSAX on every page in the book. I may or may not be exaggerating. Buy the whole market and pay very, very little in fees. He said about fees in here that compounded over time, the amount lost can be breathtaking. So VTSAX is the most popular index fund, especially within the FIRE community, without question. But if you want a few other very similar options, because perhaps you don't have access to this within, let's say, your 401k, I'm gonna put on screen 2 other options that are, again, extremely similar. You're gonna be buying all the stocks and you're gonna minimize your fees with these. Next up though, I wanna talk about another great option instead of VTSAX, which is to buy and hold the S&P 500. Now, while J.L. Collins unequivocally recommends VTSAX, if you read the book, he also says that if you own an index that tracks the S&P 500, he fully supports that as well. The Vanguard fund for the S&P 500 is VFAIX. VFIAX. But before we talk about that fund too much, what is the S&P 500? Essentially, it is the top 500 publicly traded companies in the US. What's great about this is, with his words, the losers self-cleanse and get removed from the S&P 500, while the winners are continuously added to it year after year. So in essence, this automatically sort of rebalances the portfolio for you. You don't have to do too much thinking, and it's almost rigged in your benefit because the losers go away and winners get added all the time. It's interesting why JL Collins supports this. VTSAX is roughly 80% S&P 500. So since VTSAX, the total stock market, is heavily weighted towards the S&P 500, this is a great alternative as well. Slightly more risk, potentially more opportunity, but you're gonna see in the long run, they're gonna look almost identical. So it's an extremely solid pick, and if you go with the Vanguard version of this, the current expense ratio is also just 0.04%, which is honestly lower than when this book came out. It was 0.05%. I'll put again on screen options from Fidelity and Schwab that are very similar. And the ETF version is VOO from Vanguard. So at this point, I've given you 8 specific funds. That's 2 from Vanguard's that are mutual funds, 2 that are ETFs as alternatives to those, and then 2 from Schwab and 2 from Fidelity. If you dumped all of your investments into just one of these, VTSAX, you could set it and forget it and be done. Do not pick individual stocks, pick VTSAX, and if you do that, you're crushing it. But plenty more ahead, so just a quick reminder to like and subscribe if you're getting value out of this video so far. And next up, we're gonna talk about bonds. Do you need any, and if so, which? The first thing we need to know about bonds is that bonds are not stocks. With stocks, you're buying basically a piece of the company. When you buy bonds, you're essentially loaning money to a company or the government. And by lending this money, your return is guaranteed, but the potential gains in that return aren't very high. They're limited to, let's say, 2 to 3% roughly, not the 8 to 10% we've seen from the stock market over time. So they're less risky. And this, of course, presents the question, what percentage of stocks or that one mutual fund should you have versus bonds? The way he breaks it down is that there are 2 phases in your life: the wealth accumulation stage and the wealth preservation stage. If you're in the former, still accumulating your wealth, he recommends you remain heavily invested in stocks or that one, again, mutual fund. As you approach financial independence, so we're talking within 1 to 2 years of retirement or early retirement, he recommends moving some of that money into bonds. So in the preservation stage, your portfolio might be 75% stocks, 25% bonds. You don't need to go 50-50 because you're no longer earning income and you don't want to limit the potential that these stocks could still earn over time. Especially if you are retiring early, you're going to need that portfolio to last longer, so don't be too conservative if you start pivoting towards bonds. And you might be wondering, can I buy all the bonds? Yes, you can. There is a fund from Vanguard for that. That's VBTLX. This is Vanguard's Total Bond Index Fund. And I think within it, I read that it contains something like 8,000 bonds. And once again, I'll put other total bond options on screen from Fidelity and Schwab. One of the other questions you might be wondering at this point is, should I buy any international funds? Well, it's a pretty long explanation he gives, and he makes a really compelling argument to not do that. The reason being is investing in international markets often has much higher fees. Plus, you have to think about things like exchange rates. But mainly his argument is that if you're invested in the total American stock market, you're also leveraged and invested internationally because many of the companies that make up the S&P 500 are international companies. A big portion of their revenue comes from abroad. Think companies like Coca-Cola, Ford or GM, Apple and Microsoft, you get the idea. Basically, he's making the argument that if you're betting on the US, you're betting on the world. As we succeed, so does everyone. There's a lot more to it, but I at least wanted to acknowledge that. Next, we're gonna talk about target date retirement funds. Should you be invested in them? If you already are, is there a reason to switch? Now you'll know that this is what you're invested in because the fund is gonna have a year in it, as well as the word retirement in most cases. They are extremely popular, especially within 401k accounts. That's because since 2006, I believe it is, most of the time you're gonna be automatically enrolled in one. However, these funds are not very popular for those seeking financial independence and early retirement. Okay, so what are they? They're sort of a catch-all fund. They're funds of funds, meaning they're made up of multiple index funds. The main thing you need to know is that target date retirement funds start aggressive as you're further away from that retirement year, and they get more conservative as you get closer to that year that's in the name of the fund. For example, a 2065 fund is roughly 90-10 stocks to bonds. And as we mentioned, stocks have more risk and reward as compared to bonds. However, a 2020 fund is roughly 50% stocks, 50% bonds. It is important to look at what's within that major fund, these funds of funds, and also what the expenses could look like. The pro is they're very simple. You honestly don't have to do anything. You don't even have to go through the process in most cases of investing within one. You're getting a lot of stocks, some bonds, which I like, and it automatically sort of becomes more conservative. So it is totally okay to invest in one if that's what you're currently doing. It has the J.L. Collins stamp of approval. However, just know that he feels they are too conservative. Plus, going back to fees, they're going to cost you more in fees than the funds he recommends. So if your 401k or similar retirement account offers a total stock market index fund or an S&P 500, you could put all the money into one of those, set it, and forget it. Oh, especially if it's a Vanguard one, because of, again, keeping your fees low. Okay, I am actually pretty exhausted. This is a longer video than usual because I wanted to make sure I gave you all the information you need. Now, after pulling this video together, I went looking into all my investment accounts, and I actually have some work to do. So definitely subscribe and tune in here in the next few weeks or so. I'm gonna reveal my current portfolio, my current investments, what regrets I have, and what things I'm gonna optimize and change. Yeah, I thought I was following the simple path, but mine's a little more complicated. And then I pulled together a few final notes that didn't quite fit in earlier, but I wanted to make sure that I called these out. The first one is time in the market is much more powerful than timing the market. This is where dollar cost averaging comes into play. Next, you might be wondering through all this, why is Vanguard so cheap when it comes to fees or expense ratios? They're set up different than all the other brokerage accounts or companies. They're client owned and operate at cost. This is why they don't have to pass higher fees onto you. The average expense ratio from a Vanguard fund is 0.18. The industry average is 1.01. If you're paying 2% to track the S&P 500, you're getting ripped off. Find the Vanguard alternative to that, or at the very least, go with Schwab or Fidelity. And when it comes to talking about investing, I have to make sure I say this. Be sure to prioritize your tax advantage retirement investment accounts first. Do this, max those out before you think about any personal investing. That's gonna be things like your 401k like we discussed, or your 403b or equivalent, your Roth IRA or traditional IRA, and even your health savings account investments. Okay, so that's the philosophy, that's the thinking behind it. J.L. Collins recommends VTSAX. Put most or all of your money into that, set it and forget it. Keep emotions out. You're gonna save on fees. Plus, I gave you a lot of tips, I explained the strategy, I offered alternate funds that are similar, and we covered bonds and what percentage stocks to bonds you should be thinking about. This is all super simple, and I love super simple. I hope this is sinking in and making a ton of sense to you. VTSAX and VBTLX. VFIAX is an alternative. Consistently contribute to that over time, and you can retire 5, 10, 20 years or more sooner than the average person. That's all you need to know about investing, IMO anyway. If you want to know my other secret I call out in terms of reaching financial independence, I recommend the video on screen now. I'm not going to tell you the secret because mystery and intrigue, but if you combine the strategies from that video with this video, you're going to be way ahead of the game. Investing, no doubt about it, can be intimidating. I hope this video helped break it down and simplify. It doesn't need to be complicated. The media makes it look complicated on purpose. This is the part of personal finance that honestly at this point, I probably spend the least amount of time and energy thinking about or studying, except when I'm putting together videos like this. I hope it can be this simple for you. Set it and forget about it. That's stupid. With this simple approach developed by actual experts, not your Uncle Lenny who tells you about speculative investing and Bitcoin at the family barbecues, you can be super well off. Those experts again are J.L. Collins, also Warren Buffett, as well as Jack Bogle. These are the ones I follow. Look into them if you want to learn more. In terms of books, The Simple Path to Wealth. Jack Bogle also has a book called The Little Book of Common Sense Investing that I highly recommend. What I should have mentioned is that he's actually the founder of the Vanguard Group back in 1975. he also invented the first index fund. Okay, that's what you're gonna get here at The Money Resolution. Under promise, over deliver, I hope, every single time. If you got value out of this video, give me a virtual high five by hitting that like button down below. Subscribe to The Money Resolution if you want more tips on how to save money, make money, get out of debt, and invest so you can retire on time or even early. Let me know in the comments what stood out from this video to you. Is there anything that you learned, anything you want to push back on, or something you still have a question about? Thank you for watching. Seriously, I'm super pumped for you that you're seeking out content like this one. Just by watching all the way to the end of this one, I can tell you're gonna do great. Always do your research. Don't take all your financial advice from finance nerds on YouTube, although there are some great finance nerds on YouTube. Nobody can predict the future. Definitely not me. But I can predict this video is gonna end in roughly 20 seconds. And that there's gonna be suggested videos on screen now. This one about investing. This one is that secret I told you about. All right, that's it for now. I am off to go VTSAX with some VTSAX at the VTSAX. I'll talk to you on the next VTSAX. Thanks, guys.